Two self-employed people, same $120,000 of profit. One puts away about $22,300 for retirement this year. The other puts away almost $47,000. Legally, same income, same tax rules. By the end of this video, you'll know exactly which account they each open, why one quietly saved more than twice as much, and the one-line rule for picking yours. So when the limits are identical, how does one of them legally double the other? If you're a one-person business, a freelancer, creator, or 1099 contractor, you've got two great retirement accounts to choose from: the Solo 401k and the SEP-IRA. Both beat a plain IRA, but on the same income, one usually lets you save a lot more. Here's the math, and a simple rule for picking. Pick wrong on $120,000 of profit and you could leave $24,500 of tax advantage room on the table this year alone. And by the end, you'll see exactly what that one mishap cost you over 30 years. Here's the one idea that makes this whole thing click. When you run a one-person business, you wear two hats. You're the employee and you're the employer. A SEP-IRA only lets you contribute as the employer. The Solo 401k lets you contribute as both. And that second hat is where the extra room comes from. As the employee, you can defer up to $24,500 of your own pay straight into the account. As the employer, your business can kick in roughly 20% of your net self-employment earnings on top. And that 20% is applied after you subtract half of your self-employment tax. SEP-IRA gets only that second piece. Solo 401k gets both. Let's raise the limits on the same numbers. Say your business nets $120,000 in profit after expenses. Quick honesty check before the math. These are simplified illustrations. Your actual limits depend on your exact net earnings after the self-employment tax deduction, so run your own numbers with a CPA or the IRS Publication 560 worksheet. With a SEP-IRA, you contribute only as the employer. Take that $120,000, knock off the 92.35% self-employment tax adjustment and half your SE tax, then apply 20%. That's about $22,300. That's it. That's the whole account. Now the Solo 401k, same $120,000. First, you add the employee deferral, $24,500 of your own pay. Then you stack the same employer contribution on top, that same approximately $22,300. Add them up and you're near $46,800 going in this year on identical income. So on the exact same income, the Solo 401k let this person put away more than twice as much. The whole gap is that employee deferral, the hat the SEP-IRA doesn't let you wear. Two more things tilt the Solo 401k for big savers. First, catch up. If you're 50 or older, the Solo 401k lets you add an extra $8,000 of employee deferral. And if you're 60 to 63, that catch-up jumps to $11,250. The SEP-IRA has no catch-up at all. Second, the ceiling. In a strong year, total contributions to either account top out at the same $72,000 overall cap, but a SEP can only reach that with a much higher income because it's leaning on the employer piece alone. Watch the SEP-IRA line climb as profit rises. It's one slope, about 20% of net earnings. The Solo 401k would ride well above this line the whole way thanks to that flat $24,500 head start until both eventually bump the same $72,000 overall cap. And here's the catch, the chart makes obvious. Leaning on the employer piece alone, a sole proprietor needs roughly $375,000 of net profit before the SEP maxes that cap, while the Solo 401k gets there around $250,000. At every income below that, the Solo 401k is simply further ahead. A bigger contribution today isn't the real story. It's what that extra room compounds into. Take just the gap from our example. About $24,500 more invested every year, growing at a steady 7% return. Watch where that lands. After 30 years, that single difference, the employee deferral hat, is worth over $2 million on its own. Same income the whole time. Same 7% return. The only variable was which account could hold the money. Quick honesty check. 7% isn't guaranteed. Markets don't move in a straight line, and you'd owe ordinary income tax when you pull this out in retirement. The shape of the advantage holds, the exact number won't. This is education, not financial advice. Confirm your plan with a CPA. So why would anyone pick the SEP-IRA? Two honest reasons. One, simplicity. A SEP takes about 5 minutes to open and has no annual filing. The solo 401k can require a form 5500 once the balance crosses $250,000. Two, and this is the big one. The moment you hire a W-2 employee, a SEP forces you to contribute the same percentage of pay for them as you take for yourself. That can get expensive fast. So the decision rule is clean. If you're a true one-person business and you want to save the most, the solo 401k usually wins. It's the only one that lets you wear both hats and add ketchup. If you value dead simple setup, or you have employees and don't want to fund matching contributions for all of them, the SEP-IRA earns its place. Either way, this is not financial or tax advice. Talk to a CPA about your own situation before you choose. Quick recap. Both accounts beat a plain IRA. The SEP only lets you contribute as the employer. The solo 401k lets you contribute as employee and employer, plus catch up if you're 50 or older, which is why on the same income it usually lets you save more than twice as much. For a one-person business chasing the biggest number, that's the one. For simplicity or a team, the SEP holds up. If this made the choice clearer, subscribe. We run the real numbers on one self-employed money question every week. No hype, just the math. One last reminder, this is educational, not financial or tax advice. Confirm the current year limits at irs.gov and run your situation by a CPA. Next up, how much to actually contribute when your income is different every single month? That's the harder problem, and we've got a system for it.